If we think about real estate as an industry and what it means to our economy, it is enormous. Real estate plus some of the construction trades and some of the other housing services and goods that we can include, whether it's sales by Home Depot and Lowe's for folks that are remodeling, or it's contractors who are working on homes, whether they be electricians or plumbers or HVAC repairmen. When you include all of that in the housing economy, it's probably close to a quarter of the US economy, and that's major. So what we've seen recently is stagnation. We've seen sellers removing listings and being very stingy with their price changes. We've seen buyers walking away and saying, oh, they've had enough at high interest rates and such high prices. And what that's causing is to see very low inventory and very low transaction volume. And what does all of that mean? Well, it translates into a stagnation across demand for services that surround this housing ecosystem. So what is this cut going to do? Well, the cut itself isn't going to do much, right? That quarter point doesn't mean a whole lot. But as I described earlier, the quarter point tells us that there is another quarter point and another quarter point to follow very, very soon. And all of that will start to really get the juices flowing inside that real estate economy, because that part of the economy is forward-looking. And so the players within those industries are going to start ramping up, knowing that demand is coming, right? Demand for refinances is coming. Demand for more landscaping and repair work is coming, because what we're going to get is certainly more inventory. Now, one interesting question about all of this is what will happen for prices, right? What are consumers actually going to see in terms of how they're going to transact? I actually have a counterintuitive thought about this. I think that we're going to get much more bullish activity and more demand for goods and services surrounding real estate in the next 3 to 6 months, but that is not going to amount to rising prices. So we're probably going to see flat declining prices across many markets across the US. Is that a terrible thing? No, not necessarily, because a lot of consumers who feel locked into their interest rate, locked into their home right now, they're going to get to move. So what if it's 5 or 10% below the peak that we saw in 2022 or 2025, depending on where you live? It's okay. Now you're going to be able to unlock that equity in your home, and you're going to get to move up or move down or move away because you've got a divorce going on or your job has changed. All of that is very, very bullish, even if we see real estate prices, and I'm talking about real estate on the residential side. If we see prices fall 5 to 10%, not the end of the world. Much more important that it's going to stimulate a lot of activity on the part of the market as far as goods and services and transactions. Yeah, do I think there's going to be a refinancing boom? I think all of that depends on the magnitude and the velocity of interest rate cuts. And I think that by the time we get to December, if we've seen 75 basis points in cuts, I think we're going to start to see the beginnings of a refinance boom. And what stock will benefit from that? I mean, many different companies are going to benefit from a refi boom, but I love the stock Tree, which is LendingTree, because they are the premier leader in selling leads to the mortgage broker community throughout the United States. And if you pull up that chart right now, you'll see LendingTree is already starting to rally. It's already coming off of its lows of the past few years. And this is a stock that could easily double into a refi boom. So for investors interested in how to benefit from it, this is a nice opportunity right here for you. The cut that we saw this week is already reverberating in a positive way for Main Street, right? We see the yield curve, meaning interest rates, at both the short, medium, and long end of the yield curve. And I'm talking about sort of 1 year, 2 year, then 5 and 7 year, as well as 10 and 20 year interest rates, all declining. And that is all beneficial for Main Street. Why? Because at the 5 and 7 year rates, that is where we all borrow money to finance our cars, right? Cars, boats, vehicles, etc. And the 1 and 2 year is where we store our money. At the 10 and 20 year, right? Those interest rates are the ones that affect our ability to borrow for long-term assets. And mostly that's real estate. So we're going to see mortgage rates decline. We're going to see auto loan rates decline. And then the short end is what affects some of our consumer borrowing rates, like home equity lines of credit and credit card rates. And so all of those monthly payments are starting to come down, and all of that is going to put more money in the pockets of consumers. And by the way, all of these treasury yields coming down puts more money in the government's pockets as well, because interest costs, which are enormous, are coming down for the US government as well.